Fed funds affect everyone in our industry,
Yeah.
everyone. So that's where the, uh, the successful operators really have the rubber meet the road, is when they understand the real estate financing and the power of that financing. That's when
Yeah.
projects get done.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome, listeners. Today we have a great. Today we are going to have a great show. Our special guest today is Shemesh, and he's a co-founder, senior managing member, and chief acquisition officer at Amerinote Xchange. He has been operating within the primary and secondary mortgage markets for last 2 decades. And his background lies in real estate and commercial mortgage loan origination. And currently he has transitioned over to secondary market and whole loan acquisitions. And he has been doing this since 2006. Today we'll just pick his mind and get some bird eye views on the current and future state of the lending market. So welcome, Abby. Nice to have you on the show.
Thank you, Ted, for inviting me. I greatly appreciate it. And I thank you for allowing me to share thoughts on the system and the market at large.
Yep, it will be a great show. Yep. So, Abby, before we get started, right? If you can just give a little bit background, how you got started in this lending industry, and where are you? What are you currently doing?
Sure. So my career started in loan originations in the state of Pennsylvania back in 1999-ish, 1998, 1999, 4 lifetimes ago, I guess you could say. And which kind of evolved into, well, we primarily focused on, I was part of a firm that primarily focused on traditional residential mortgage lending, both purchases and refinances. Of course, this was at a time when the subprime mortgage market was taking hold, which was a very busy time in the mortgage industry back then. I moved through the, I guess you could say, the ranks from a junior loan officer, working my way up to senior loan officer, and then of course transitioning over to another firm out of New Jersey, which kind of expanded my capabilities of lending both in the residential and commercial spaces across 16 states. At which point, at that time, we gained quite a bit of experience in that realm. And from our account representatives that would visit our office frequently, indirectly found out about the secondary mortgage market, which I had no idea existed. Learning more about the secondary mortgage market, I really started kind of exploring that and found it very intriguing because of the fact that it was so unsaturated. There was way less saturation in the secondary mortgage market. And that to me was attractive because I saw a lot of room for growth, and really started exploring that ferociously, and made the full transition. I want to say, I think it was late 2005, early 2006, and made the full transition, founding Amerinote Xchange. And what we currently do is Amerinote Xchange is a whole loan acquisition firm, which means we purchase existing mortgage loans of all flavors, all collateral types, all lien positions across multiple jurisdictions, meaning all states. So, and there we've been operating since 2006.
Sounds great. Yep. So, Abby, in my early career, I used to work with investment banks. I'm well aware of all these MBSs, the whole mortgage pass-through process, selling to Fannie Mae, Freddie Mac, how the loan gets originated by by a small bank, and where it goes, the investment banks then buys the MBS, all the whole through cycle. So you come in the middle picture, right? You buy the loans directly from small banks. Is that true?
That is true. Yes, the small banks, medium-sized banks, but a lot of the loans that we purchase are private lenders.
Okay.
Seller finance is a big part of our
Okay.
demographic, a much bigger
Hmm.
part. So just to kind of take a couple steps back, when we started in 2006, we did not start with institutions. We started with private loan acquisitions, but we were using capital that was being sourced from institutions up, of course, until the 2008 market crash. But we had a tremendous amount of success in the seller finance space and still primarily operate there. I would say, if I had to put a percentage on it, about 65% is still seller financed, probably more like 40% of that of our business comes from banks. And that's been the largest share because banks have a lot of places to go,
Yeah.
right? As you
Yeah.
mentioned, they can go to Fannie, they can go to Freddie, they can go to Wall Street.
Yeah.
We typically deal with banks when the money printing stops. That's when the banks approach us. When
Okay.
the subsidized cash is not flowing and the Fed is increasing rates or there's some sort of turmoil, either nationally or globally, that's when the banks really start approaching firms like us. But we've always maintained relationships with banks, maybe not, traditional single family residences that had plenty of places to go during the good times, right? When interest rates were
Hmm.
low.
Yep.
But the collateral types and the assets that we were seeing were special use properties, commercial places of worship, mobile home parks, things that were off the beaten path of traditional Wall Street firms.
Mhm. Do you buy whole loans related to multifamilies, small multifamilies, or maybe uh, I would say single? You don't do anything in the single family space now, right? It
We
just
do. No, no,
you
we,
do?
we do so all flavors of collateral types, which include single family residences, multifamily, that could be 1 to 4, that can be 5 plus, that could be apartments. We also operate within the commercial retail space, commercial mixed use space, commercial medical office space.
Okay.
We have a really good handle on many different collateral types. There are certain collateral types that we're not um, too competitive on, and that would be like environmental
Yeah.
properties, gas stations, chemical factories. We'll do automotive. We don't have a lot of interest in those too much,
Hmm.
um, but we have a very wide berth of asset interest, collateral
Okay.
type, as well as performance levels and lien positions as well.
Okay. Yeah, sounds great. So now let's take a little deep dive into commercial loans.
Sure.
If you can explain my listeners what are the different type of commercial loans available, and like bridge loans, agency loans, just an example, right? And if you can get into more detail, like what are these, what are the criterias, what is the preference, like when to use which kind of loan?
So coming from a perspective of when you say to use which type of loan, I just want to clarify, are we talking about the perspective of a borrower, correct?
Yeah, perspective of the borrower. Yes.
Perspective
Yeah.
of the borrower.
Yeah.
So when it comes to the commercial side, and of course, every property will have a different strategy, right? You
Hmm.
can say commercial if we're talking about multifam. Of course, assuming that you understand the jurisdiction that you're operating in, both legally and demographically, there's going to be a strategy there that a borrower needs to understand. Now, assuming that that is understood by the borrower, and there's a good handle on that, that will really help you um, curate your plan
Hmm.
to executing the transaction. What I mean by that is like you said, when do you use a bridge loan? When do you use an agency loan? Well, when do you source private capital? Um, Typically speaking, it's really going to depend on the asset or the jurisdiction that you're operating in. So for instance, if you are operating in an urban or a suburban area, let's just say like, I don't know, Atlanta, Georgia. Atlanta, Georgia is going to have a certain strategy that borrowers are going to want to adhere to that may not work, say, like the same as it would in Missoula, Montana, or in, Peoria, Illinois, or Harrisburg, Pennsylvania. There's going to be different markets for different types of properties and different types of strategies. So in a bridge loan situation, you really got to have, I mean, a bridge loan is exactly that, right? You're looking to bridge capital between the time, a short period of time. It's usually an interest only structure. They're usually non-recourse loans. Typically speaking, you're going to see a balloon payment. On that, you want to make sure that you have some sort of exit strategy. The lender that is lending you the money, sometimes depending on the loan to value and the purpose of the loan. Like for instance, if you're operating a property project and you're going to put a bridge loan into use, you want to make sure that you're not just, throwing caution to the wind and you're going to keep your fingers crossed that everything is going to align. You need to make sure that there's multiple exits there. For instance, let's just say you're doing like a multi-fam construction, right? Or a remodel on a property that you purchased that has 25, 30 doors. You're trying to get this up and going. You have most of your capital. You need to bridge that capital, or you need to get a bridge for the finishing touches, then where you can list it, and then of course recycle that capital. There's a lot of things that need to be understood, but in that particular case, you'd want to make sure that there's a sound exit strategy. You'd want to make sure that you're not just relying on the sale of that property, right? So is this going to be a long-term hold? Is this going to be a short-term flip? What's the purpose of that? You don't want to use a bridge loan for a long-term play unless you got some sort of long-term lender that's going to take you out, especially if you plan on renting that property out. So to answer the question directly, it's going to boil down to strategy. It's going to boil down to geolocation. And that to me is what determines which type of loan product you're going to go with on the commercial side.
Sounds great. And what are the different things you think borrower needs to take care of, like even before they apply for the loan? Let's take maybe a small multifamily construction project. Okay.
Mm-hmm.
So what are the things that you think borrower needs to make sure they calculate, or DSCR ratio, LTV ratio before even they apply to make sure they meet the underwriting criteria?
Sure. So I've seen time and time again where borrowers are in their excitement to do the project, right? They miscalculate on the debt servicing ratio. They miscalculate on the loan to value. They think that property is just going to go up forever. And, we're in a very unique time right now where the interest rate environment has not been as fragile or as inflationary as it has been since, the 70s, the 80s, right? And there's a lot of people in this space, in the commercial mortgage space, in the commercial real estate space, that have entered the market in 2014, 2015. They don't know what inflation looks like.
And what the high interest rate is.
When the high interest rates look like. So this information is more prevalent now than it has been in the past 4 decades, definitely over the past 1 decade for sure. But you really need to buy the properties correctly, right? So if you're buying a project, if you're putting cash in, if you say a ground up construction, you want to make sure, and there's a lot of ground up construction that's happening right now where a lot of those properties were purchased at the height of the market, right? The COVID boom. That as of this recording in May of 2023, we see that there is a ton of properties now and a ton of dislocated sellers I'm talking about lenders that bring us loans to sell. And the lenders, mindset, the way that they're looking at it is completely dislocated from what the reality of the market is, because they're so used to that cheap, subsidized money coming from the Fed, and
Yeah.
then all, being kind of printed into the M2 money supply. Um, we see a ton of borrowers making that mistake, and they think that the borrower's strong. They got 700 credit. There's a personal guarantee. There's 20% equity. The DSCR is 1.1%, not great. You know what I mean, or whatever, 1.01% or whatever. You need to prepare. You need to build, as we say in our firm here, and I'm sure maybe you've heard, if you need to build in enough emergency runway for a crash landing, because right now the financial meteorology is turbulent for ground up constructions, both in residential and commercial, specifically in commercial, more than residential, depending on the jurisdiction.
Yeah.
I can tell you, we operate here we have an office, our headquarters is in California, and our production office is in Miami. There's two major cities with two very, very different situations that are
Yeah.
happening right now. We're seeing a ton of fallout from ground up. Right now we're currently working on a ground up construction loan acquisition that fell flat because the balloon payment couldn't be made. It's in the dead smack in the middle of Seattle. I mean, where the market was hot. They're micro units, so they were really trying to do the affordable housing thing. They miscalculated on the fact that the demographic that they were shooting for were usually the 20 to 30 somethings. These 20 to 30 something micro unit tenants, they can easily pivot out of those micro units. They can easily move back into mom and dad's house. They can easily move in with a friend on the sofa. They miscalculated that completely. They also miscalculated their exit strategy on the balloon payment, which they missed. And now
Yeah.
that's why the loan landed on our desk for acquisition, because the lender has had it. They don't want to take back a ground up construction in the Seattle jurisdiction because of all the jurisdictional restrictions. So you really need, and this was a beautiful asset on paper. I don't have the exact terms to memory because we just started working on it, but the whole enchilada changed. The whole picture changed in the past 8 months, and no
Yeah.
borrower could see that coming. And my advice to borrowers are: if you think you need 30% LTV, work in 40% LTV. If you're looking for a 1.25 debt servicing ratio, work in a 1.5 or higher. Whatever the case is, you want to make sure that you're building an emergency runway. Do not get cocky. And I know that's a tough thing to swallow because it comes down to the dollars and cents of this. But if you're not buying the deals right and you're not sourcing the deals correctly, you're putting yourself at great risk, especially if you're signing off on a personal guarantee.
Yeah, absolutely. And you were right on when you said it depends on the local market. It comes down to location. We have been, doing the ground up construction in New Jersey, as you know, and the market is still hot in Jersey. It's some of the properties that we build, like the luxury single family homes, which are priced anywhere above like 2 million. They just even before the construction is over, they are under contract.
Wow.
Yeah. So
May I ask,
still, yeah, keep my fingers crossed. It stays the same, for a while.
is that North Jersey?
North Jersey.
North
Yes.
Jersey, and that makes sense. Yeah, that makes a
Yeah.
lot of sense. In North Jersey, of course, you have the New York greater New York area. It's going to require that kind of housing. Whereas if you try to go into Cherry Hill, New Jersey,
Yeah.
or South Jersey across from Philadelphia, you're not going to see that same robust opportunity. So it's all about jurisdiction.
Absolutely. And you were spot on when you said, uh, everyone needs to make sure they have enough buffer cushion, to make sure they make the timely payments. And whenever the balloon payments comes up, they need to be, if they're syndicating, if the property, then they need to start either stop doing the distribution or raise more money to make sure they can close the loan with the bank and then
That's correct.
refinance, if needed.
That's correct. I've seen if you have a balloon coming up and if you need to raise capital, we see a lot of borrowers put on the back burner. Oh, well, the balloon's due in August. We got plenty of time.
Mm-mm.
It takes, we see underwriting processes last on commercial loans for 120 days, 90 days. Of course, you wish not to see that, and that's not typical across the board, but you got to pretend like that's what it is. Better that you're early to the game than late to the game, especially when you're playing with such large consequences. Some people, sounds like you're a very experienced operator in the North Jersey area. I could tell you that we deal with a lot of experienced operators. We deal with a lot of non-experienced operators, and we've seen people lose everything because of hubris and
Yeah.
not planning properly. So it's very, very important.
Yeah. Yeah. And the thing is, while the interest last year, when the interest rate was rising, we always used to underwrite any deals, keeping the future interest rate in mind. If the interest is going to, if say like in next 1 year, or in next 6 months, if it's going to go to 200 basis point or 250 basis point, we just take into consideration, okay, this is the interest rate after 6 months, this is the interest rate after next 6 months, and plan it accordingly.
That's right. We typically listen to what the Federal Reserve says. A lot of people are stunned. They go, how did you not see this coming? If you look at what Jay Powell says, or Bernanke before him, and you just kind of say, okay, the Fed plans on doing this. It's not rocket science. Of course, it takes a minute to kind of source and find that information, but they're very transparent in how they proceed. They tell everyone what they're going to do, and Fed funds affect everyone in our industry, everyone. So that's where the successful operators really have the rubber meet the road, is when they understand the real estate financing and the power of that financing. That's when projects get done. Of course, there's other points like good market conditions and so forth. But that's good to hear on North Jersey.
Yeah. And like recently, right? After the last raise, there is what do you think? Like, are they going to increase more? Because according to me, maybe they might go 25 basis point more in next few months. Do you think it's going to be more than 25 basis point in the future?
No, I don't. I'm pretty sure that they're going to continue on they've painted themselves into a corner. So you got to understand too that they are still, there's a big question here, right? So the short answer is no. I don't think that they're going to go higher than 25 basis points. Now, if the information on the ground changes, then it's very possible that they may increase or they may even pause. I think that the increase may happen is if inflation gets out of control, right? More so than it is now. I think that they're going to pause if employment falters and falls flat. Once employment issues start to creep up into headlines, you may see downward pressure from the administration to, compel, I guess you can say, Mr. Powell and his staff to, start thinking about pausing interest rates so they don't create a full-blown depression. I am of the opinion, I don't know if it's opinion, I think it's a fact. I could be miscalculating this, but what I see is I still see them printing money. They're just not doing it through the front door. So the Federal Reserve has this new facility, and the Federal Reserve, the facility is for assets that I think it's called the Bank Term Funding Program, or BTFP, which is offering loans up to 1 year for lengths, 1 year in lengths for banks, savings associations, credit unions, and so forth, for assets like underperforming assets or
Mhm.
assets that are falling below the market rate. And they're calculating these at par. So if you have a portfolio of loans and you
Mhm.
take that portfolio of loans to a company like ours and we offer you 80 cents on the dollar, or 80%, they can take that same portfolio, and because that's what the market will bear. It's only worth
Yeah.
80 cents on the dollar because the interest rates are 3.5%.
Yeah.
So we have to discount it in order to make up that difference.
Yeah.
They can take it to the Fed's new facility and say, here is my mortgage portfolio or my mortgage-backed securities. The Fed will give them par, or 100 cents on the dollar, and lend them money 20% more than what the asset is of the collateral. So
What if the default? What happens? Who takes
it's a good
the
question. I'm pretty sure the taxpayer. I'm pretty sure, but don't quote me on that. That's as far as my investigation, my research into that went. But when you're funneling money through these facilities that have very, easy names like the Bank Term Funding Program, it sounds kind of harmless as it is, and then you
Mhm.
find out that they truly are. I mean, this money's not coming out of thin air. They're printing it, and they're doing this by the billions to these banks. So the banks don't have to. It's to secure the fact that banks aren't going to fail. So all of their underperforming or tied up assets in treasuries or in low bearing interest mortgage instruments or anything like this, mortgage backed securities that are locked
Mhm.
up for 10, 20, 30 years, they can now pledge as collateral and borrow over 100% of the value of that collateral at the
No.
expense, I'm assuming, of the taxpayer. So that to me is also creating and adding to this inflationary environment. So
Mhm.
again, just what I'm seeing on the ground here.
Uh-huh.
I could be wrong. Maybe some of your listeners will fact check me on this, but I would like to see the market correct itself in a more organic way. So a lot of people are saying, well, how come there's not a lot of loans hitting the market? Where are all the non-performing loans that were supposed to be hitting the market after COVID, or all this? And it's
Mhm.
I understand why the Fed's doing it, but they're omitting some of the information. There's being information that's being omitted from not just the public, but there's multiple people in our industry that aren't aware of this, and they want to know.
Mhm.
So, back to the question, I'm pretty sure that as long as that facility stays in place, they're going to continue raising interest rates. They have to, because they're printing money out of this side of the mouth and they're raising interest rates out of this side. And
Yeah.
that is what central planning looks like in the financial system.
Mhm. Now, talking about the banks, right? Uh, uh, there, you know, the big news that came in before a month or two about Silicon Valley Bank, the
Yes, sir.
situation that they were. So let's talk about the current market situation. What do you think about the current liquidity in the bank, and what do you think about the future? Like, of course, the small banks, they are also in trouble. I see, who has been holding uh, commercial real estate, mainly like office spaces. Due to this COVID situation, people hasn't been going to work and the office spaces are empty. So those kind of mortgages are at high risk. Um, and uh, there are a couple of other banks also that one of them, I don't remember the name, which JP Morgan Chase just bought. Uh,
Yes,
yeah,
Signature. Not
Signature.
Signature. First Horizon. Excuse me.
Yes, first, yeah,
First
that's
Horizon.
the
Hmm.
First Horizon.
Hmm.
So
Another San Francisco bank, by the way.
same in tech area, right?
Yeah,
They
same
did
tech.
it
The heavy tech.
heavy
Yep,
tech.
yep.
Mhm.
Heavy crypto. So
Heavy
just to
tech.
throw it out there, cryptocurrency startups were not the primary, but a huge bulk of Silicon Valley Bank's
Mhm.
holdings. And the same with First Republic. It has a big tech footprint. A lot of that is the crypto, and there's an organized offensive from our government to kind of crack down on this. Again, just making just an anecdotal point there, but that has something I feel to do with it for sure.
So now, what do you think about the future? Like where or liquidity condition for the bank? What's your opinion on it?
I think that what we're looking at is a bottleneck, right? So the fractional banking system, albeit not perfect at all, it is definitely decentralized. So there's banks all over the country that can operate within the fractional banking system and create new money by taking in deposits. And I think for every for every million that they take in, they can lend out another 9 million or something like that, 10 million, something to that effect. So
10 times, 10 times
10
normally.
times, 10 times normally, exactly. So in that being said, I feel that there's a bottleneck happening right now where they are squeezing the environment, whether it be a centralized planning squeeze or an environment like a organic environment squeeze. Like this is just the nature of the free market correcting itself, which I don't really think I'm seeing with my own eyes. What I'm seeing is a combination of both, but mostly central planning or central planners picking, as they say, winners and losers. And what they're doing is they're trying to bottleneck all the banks and reduce the number of banks that operate within the fractional banking system to eventually get to probably 5 or 6 options that we're going to have in this country. And I would say that that's probably would be the outcome that we're going to see. I would imagine J.P. Morgan is going to be at the top. Bank of America is going to be another one. Wells Fargo is going to be a winner. And then after that, there's maybe there's a couple others I'm probably missing, but I think that those are going to be the big winners. I don't think we're going to see a lot of banking options. 5, 6, 10 years from now, the banking market's going to look a lot different. What does that mean? I am not 100% sure. I do know it has a lot to do with the restructuring of our monetary system through central bank digital currencies. That has
and a lot of fintech coming up, right?
A lot of fintech. It's exactly right. So there's central bank digital currency is blockchain, really. It's the difference is that it's a centralized blockchain, not a decentralized blockchain. So it's a very highly controlled. So I had someone in my industry say central bank digital currency is akin to programmable coupons. So here's your coupon. You have to spend it within this amount of time. You can only spend it here, here, and here. And that's how, in layman's terms, how a central bank digital currency would be the best way to be described. Again, I'm not there's a little bit of a bias here. I'm sure you and your listeners can sense. I am more of a free market Austrian economics kind of person. I'm not necessarily a Keynesian economics kind of person. And
I also believe in the free market. Let the market do what it needs to do. Let it come to a balance, demand and supply. That's the thing.
Correct. And we haven't had a free market for some time, but it's definitely, if this CBDC happens, I think that's between that and the banking, the contagion in the bank. It's not separate incidents. They're connected. It's all part, either directly or indirectly, of the same effect. And this is not just the United States. We're talking about Western society at large. We're talking about Australia. We're talking about New Zealand. Obviously, Credit Suisse went under. I'm pretty sure Deutsche Bank is another one that's kind of experiencing some issues right now. I could be mistaken about that. But there's other ones that are going to fail. Whether they let them fall like a controlled demolition or it's completely by surprise will remain to be seen. But it seems like they're clipping the crypto banks first. And let's not forget, Silicon Valley Bank wasn't the first bank. The first bank was called Silver Lake Bank. And Silver Lake or Silvergate? I'm pretty sure it's Silver Lake. Silver Lake Bank was the bank that operated completely in crypto. So Silver Lake, let me just double check on that.
Yeah.
Silver Lake Bank, yeah, out of California. So they were a bank that just completely collapsed because they were actually financing crypto companies directly, 100%. So they collapsed first. About 4 days later, Silicon Valley started wobbling, and then of course First Horizon, Signature. Signature was another one that was heavily involved in the digital asset space. As a matter of fact, Bernie Frank, former congressman of Dodd-Frank, sat on the board. He went on national television and made it very clear that the reason he feels that they were targeted was because of their digital assets holdings or their operational footprint in digital assets, specifically crypto. So he said our bank was perfectly healthy. They just decided to come in and, take it over. So I find that troubling.
Yeah. Yeah. Let's see what happens in the future. I hope the market stabilizes, the bank gets enough liquidity. That you never know.
Yes,
Yeah,
I want to end on a positive note here. I do
Yeah.
think the market will stabilize. I do think that there's going to be a massive, massive amount of money that's going to be made because of this, not just at the very, very top, but folks in the middle and the ones even on the bottom that are adventurous and aggressive in their financial and strategy approach. There's a ton of money that can be made, and there's going to be a need for this real estate lending, especially in the commercial space.
Absolutely. So what do you think as of now? What are the things that the borrower needs to take care of? Like, who has borrowed the money? All right. Now the interest rate are at the high. Maybe it might reset in next 6 months or 1 year. What are the things that borrower you think needs to take care of before it increases or resets?
It depends, but I know a lot of borrowers listening or potential borrowers listening to this. I was like, come on, that's impossible. But what I would highly recommend that is if you can get that back. I know in a construction situation, every dollar counts. You want to make sure that you're putting, as much as you can into it. I also seen a lot of borrowers flush with cash, cut corners here, cut corners there, maybe not spend the money where it needs to be spent. I would highly recommend against that. If you want to stay on, and I know a lot of people are probably going to cringe when I say this, but just like your health, whether it's a diet or keeping yourself, in shape, maintaining a healthy eating habits, the same thing would be said for financial habits. And what I would highly recommend is that you try to get that balance down. If you have the ability to make principal reduction payments in addition to getting the construction built in a way that would make a great return on investment, pay down that mortgage before that refinance comes. That will reduce your loan to value. That will reduce your risk and your ability to hear when the refi comes. Sorry, our LTV model has changed because of the liquidity crisis or there was another banking crash. So we're going to have to deny your application unless you can come down with another 10% to pay down the loan. Do that while you have the ability to do that. If you have the ability to do that, that would be my first recommendation and suggestion. Also, in addition to that, you want to make sure that if you are pledging your credit as a guarantor, you don't go out and buy cars, and you want to make sure that you're maintaining your credit and your credit worthiness in a way that would allow you to not even have the underwriter question if you're going to be able to make that payment. And that goes for you, that goes for your partners. You want to now is not a time to be lavish in the lifestyle if you have operational responsibilities for construction build. That would be my biggest suggestion.
Yeah. All right. A lot of good suggestions, opinions, and a lot of information. So maybe we can just keeping time in mind, we can
Sure.
go to the last final round, which
Sure.
are just the simple, personal or motivational questions. Ready for it?
I am.
All right. So the first one, which book would you recommend? The one that has made a major impact on your life, your business, or your career?
There are a couple of them. From this conversation, I know we delve into real estate, commercial real estate, but in order to understand real estate, we really need to understand the way that the money system works. So there's several books. I am as from our conversation, your listeners may, and I don't mean to switch genres on you here, but your listeners may, I'm not just in the real estate mortgage space as a career. I'm also personally involved in the digital asset space.
Oh,
And I've read a lot of books on how money works. The book that I think that made the biggest impact on my life and the way I look at business going forward and planning is this book right here. And this is not a book that folks may like to read so much, but that's called the
hmm.
Bitcoin Standard. And it's more not necessarily all about Bitcoin. It's about the history of money and how we transfer value, whether that value is through gold bars or real estate, generational wealth, how you pass that wealth on to your children, how that worked back in the 1200s, how that worked in the 1600s, how that worked in the 1900s. It's fascinating. And to me, everyone, especially in business, especially in the finance business, should understand how money works. I find it that the CAO and CEO of Amerinote Exchange, Amerinote Capital Funding. I'm not the CEO of major banks or credit unions, but yet I find myself sitting across the table, so to speak, with a lot of CFOs and CEOs of major banks, pretty large banks and credit unions that we transact with. And I find myself having to explain to them how money works. And to me, that blows my mind. The value of money, the fragility of money, the sound money, unsound money. So this is one book. The other book that I would read that's really making an impact, which is along that same vein, is our friend Ray Dalio, and that's the Changing World Order. And this really
Yeah.
describes how empires are come and empires go. And that doesn't just translate into nation states, it also translates into individual sovereignty and how we should treat our finances. So there's a theme here, as you can see. It's physically fit in financial status and financial health. I don't know it all. I'm still learning, just like everyone else. But these two books have made a huge impact in my life.
Yeah, interesting. Yeah, maybe I'll have to uh, also buy this book and read it through.
Sure, very
Yeah, yeah.
interesting.
That's a good suggestions. Yeah. So the next question, what is the best advice that you will give to our listeners? It can be on the lending space, motivational, personal, and any kind of advice.
Yeah, that's a powerful question. I find that the biggest advice is this is going to sound so cliche, so please, audience, forgive me for this cliche kind of thing. But what I've learned over the years of operating in all the businesses I've been involved in, primarily mortgage finance, mortgage investment, is I love when people tell me this can't be done. That's impossible, or something along these lines. It took me many years to trust the little voice in your head that gives you the feedback if this is what you should do, what you shouldn't do. I put a lot of faith into the very, very strong team and highly sought out professionals that we surround ourselves with. But I never ever allow that little voice to be outshadowed by someone externally. I've made a
Yeah.
lot of mistakes by doing that. And again, I know this sounds very cliche. What I would say is that first of all, you don't know what you know. You don't know what you're getting. You don't know what you're doing until you get in there and actually do it. And along the way, you're going to make mistakes, and don't be afraid to
Yeah,
make mistakes at all. And you also want to make sure that you follow that north star, that voice that talks to you from here. And it's hard. Look, I don't
yeah,
do it every single time. That's not perfect, but I'm learning every day more and more to trust that voice. That goes for finance, that goes for investment, that goes for personal life, that goes for everything, family, everything. And I know it's a wide and general description, but if you really sit with it for a minute, I'm sure people can really think back and say, yeah, you know what? That actually makes a lot of sense.
absolutely. It's only, there is nothing like mistake is the first stepping stone to success, people say, right? So you
Yes,
learn by mistake, you gain experience. Just make sure you don't repeat the mistake. That's it.
that's exactly right. That's
Yeah,
exactly right. And but the famous saying is, fool me once, shame on me. Fool me twice, or fool me once, shame on you. Fool me twice, shame on me. And
right.
that's true.
Yeah,
You make the same mistake, and I've made the same mistake twice. So not a guru here in that aspect at all.
all right. One second last question, actually. How,
Sure.
uh, what is the one way you would give back to the world? You like to give back to the world? Yeah.
It's a very interesting question. This is going to sound a little uh, off the cuff, but I, when I give back to the world, there's some people that give back to the world by writing a check, which is fine. I'm not one of those people. I'm not saying I haven't donated, but cash is sometimes needed, but it's not always applied. What I like to do when I give back is I like to be energetically connected to the person or people that I'm giving to. What I mean by that, I'll give you an example. My staff thinks I'm crazy because as the one of the C-suite executives here, my job is to make sure that the big picture is in place, right? The money's there, that the leads are there, we have lead gen, that the employees are happy,
Mhm.
and then the employees work the business, right? That's typically how it is.
Absolutely. Yeah.
I my what I love to do is I love to interface with humans. That's my superpower. Is I interface with humans, and what I really like to do, especially in the seller finance space, you really learn when you pick up that phone and you get a call and it's a lender. And I'm not talking about a sophisticated lender. I'm talking about someone who's very unsophisticated that has almost no options. And these people, I can sometimes hear, I swear to God, I get these calls. I would say, I don't really answer sales
Mhm.
calls, but sometimes I do. And then when I get that person who's like, I just need help. What do I do? I tell them, I said, look, I'm not an attorney. The only license I have is a driver's license. But this is what I would do if I were you. And I
Yeah.
really try to give back. Like if I can help someone, which I swear it happens 5, 6, 7 times a month, and we get a lot of business, a lot of calls from private investors, divorce situations, family disputes. My uh, neighbor bought my house from me and talked me into carrying a mortgage from them, and now I
Yeah.
got a non-recourse loan with 0% interest, and no one will buy it. What do I do? I will literally walk them sometimes. And I know my staff would kill me if they heard me saying this, sometimes 30, 40 minutes on the phone, taking them step by step. This is what you need to do. You need to call a person like this. You ask them this, and this. Once they get you that, then, if you have any questions, you can call me back, and then we'll go ahead and we'll try to find you. I can put you in contact with someone who may be able to find you a good attorney. I give them free advice. And it's not just advice that would be like, hey, go to this website. I really try to get in there. And to me, a lot of these people, it's more than once, are brought to tears. And to me, that
Mhm.
means everything. If I can just help one person like that, a person that no one there's no monetary incentive for anyone to help this person whatsoever. There's no money in it, right?
Yeah.
So they're like, can't help you, sorry. I don't care about that. I just want to help. And that's one of the many ways that I do what I can do when I can do it. But there's always the desire to move into philanthropy after this career. And that's exactly what I'm going to do. So there's going to be,
Awesome.
many different
Yeah.
ways for
Yeah.
philanthropic activities coming
Yeah.
up. So I have some ideas.
Yeah. No, absolutely. Helping is one of the best thing, instead of handing over the money, if you help that person, it goes the long way.
Exactly.
Yep.
Exactly. And especially if you can see the result. And sometimes I get these people to call back and say, oh my God, it's very rewarding for not just
Yeah.
them, but for myself.
Yep. Absolutely. So the last question before we end the show, how can Decoding Cash Flow listeners get in touch with you?
Sure. So the best way to get in touch with myself is to go to our website, which is Amerinote Xchange.com. The word exchange is only spelled with an X, and you will find us at our contact us page. It can also be found on Twitter. My name is Abby Shemesh, which is my handle at Twitter. And of course, I am also, our company Amerinote is on Twitter as well as Amerinote X. So at Amerinote X. But the easiest and the quickest way is to get a hold of us through our website, AmerinoteXchange.com.
Okay. Thanks a lot, Abby. Thanks for being a guest on this show. You gave a lot of good information out to our listeners. Hopefully, they'll be able to apply in their real life. Thanks a lot.
Thank you, Ted. Thank you very much.
Thanks.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.